This week, the lab collected $9,706 in net premium across 49 option trades. MARA, SPY, and Coin. All wheel and PMCC strategies running in a live brokerage account. Here is exactly what happened, what was traded, what it cost, and the one trade that delivered the most expensive lesson of the week. The numbers are real. The account is real. Nothing here is backtested or hypothetical. This is Trade of the Week, number 1. Welcome to Mathematical Money, the lab. My name is Adrian, and this channel is where the strategy gets built in public, 1 week at a time. Here is the full summary for the week of April 1st to April 9th, 2026. Premium sold, $14,854. Premium bought back, $5,148. Net premium collected, $9,706. Total trades executed, 49. Broken down by ticker, MARA accounted for 30 trades, SPY 17 trades, and Coin 2 trades. All figures are extracted directly from the Tiger Broker's statement dated April 9th, 2026. There are no estimates and no rounding here. These are the exact cleared numbers as reported by the broker. Every episode in this series will use the same scorecard format, so you can track the cumulative premium build across every single week. Here is the current portfolio snapshot as of April 9th, 2026. MARA, 46,546 shares at an average cost of $14.44, currently trading at $9.67, carrying an unrealized loss of approximately $222,000. Coin, 200.8 shares. BMNR, 400 shares. Active option legs span MARA covered calls and cash secured puts, SPY PMCC legs, and put spreads, and coin covered calls. Total account equity is $642,833. The unrealized MARA stock loss remains the single largest drag on this account right now. The weekly option premium income is the systematic mechanism working against that drag, recovering ground dollar by dollar, trade by trade, every week. The most educational trade this week was not a winner. On April 8th, 2026, the long leg of a MARA poor man's covered call was closed at a realized loss of $2,515. The position was the June 2026 $15 strike call, purchased as a capital-efficient substitute for owning 1,000 shares of MARA outright. When MARA was trading above $15, this position carried real intrinsic value and made logical sense as part of the strategy. When MARA dropped to $9.50, the math changed completely. This trade is exactly the reason this series exists, to show what goes wrong, not just what goes right. A poor man's covered call, or PMCC, replaces 100 shares of stock with a deep in-the-money long call option. The long call is cheaper than buying shares outright, freeing up capital. You then sell short-term calls against the long call to collect premium, just like a standard covered call. The strategy performs well in uptrending markets where the long call gains value. The core risk is this. If the underlying stock drops far enough below your long strike, the long call loses most of its value. You are left holding a decaying asset with no intrinsic value and very little time premium remaining. The MARA June 2026 $15 call was purchased as the long leg when MARA was trading at a significantly higher price level. The position consisted of 10 contracts, each representing 100 shares, giving total exposure equivalent to 1,000 shares of MARA. The cost of establishing this long call position was $2,755. The intent was straightforward. Use the long call as a cheaper substitute for buying 1,000 shares outright, then sell weekly short calls against it to generate premium income. That logic was completely sound at the time of entry. The problem was not the strategy itself. The problem was what MARA did next. When MARA fell to $9.50, the $15 strike, June 2026 call had a market value of just 24 cents per contract. 10 contracts times 24 cents times the 100 multiplier equals $240 recovered. The original cost was $2,755. Realized loss on exit, negative $2,515. That is the math of a deep out-of-the-money long call with 10 weeks remaining. Almost all of the original premium was gone. The position had shifted from a leveraged upside vehicle into a nearly worthless asset. At that point, the decision was binary: hold and watch it decay to zero, or sell and recover the remaining $240. For this position to recover to break even from $9.50, MARA would need to rally from $9.50 all the way above $15. That is a 58% move in approximately 10 weeks. Given current market conditions and MARA's recent price action, the probability of that recovery happening before June expiry was near zero. Holding would have meant watching the remaining $240 in value decay to nothing over the following weeks. Selling at $240 recovered capital that could be redeployed immediately into a higher probability trade. The decision was not about cutting a loss emotionally. It was straightforward capital efficiency and probability math. On the same day as the MARA Unwind, April 8th, one SPY December 2026 $675 call was purchased at $50.22 for a total cost of $5,022. The following day, April 9th, a second SPY December 2026 $670 call was purchased at $55.36, adding a further $5,536 to the position. These two long calls now form the foundation of a new PMCC structure on SPY rather than MARA. The rationale is clear. SPY carries significantly lower single stock volatility, provides broader market exposure, and still has over 8 months of remaining time value. The short call legs will be sold weekly to generate offsetting income. Despite the $2,515 PMCC loss, the premium collection machine kept running without interruption. MARA covered calls were rolled weekly across lots of 10 to 30 contracts at $10 and $12 strikes. MARA cash secured puts were sold at $7.50 and $8.50 strikes. The SPY side alone contributed $4,624 in net premium through put spreads during the same week. The wheel strategy does not pause for one bad long call position. It continues collecting premium on every position, every week, regardless. The PMCC loss was a direct cost of the MARA directional bet going wrong. The wheel is a completely separate, non-directional engine. The MARA PMCC position in this account was 10 contracts. On a $10,000 account, the appropriate size would be 1 contract. At the same per contract loss, the realized loss would have been approximately $252 instead of $2,515, exactly 1/10. On a $50,000 account, 5 contracts would produce a loss of approximately $1,258. The lesson is completely identical at every account size. When a long call is this far out of the money with only weeks remaining, the math says sell, recover what capital remains, and redeploy it into a better trade. The position size scales. The decision framework never changes. A PMCC is a directional, leveraged bet on the underlying stock moving higher. The wheel is a premium collection machine designed to generate income regardless of which direction the stock moves. These two tools serve completely different purposes and carry very different risk profiles. When MARA was trading above $15, the PMCC amplified returns and the long call held real intrinsic value. When MARA dropped to $9, that same PMCC amplified losses. The wheel kept collecting premium throughout both scenarios without missing a week. The takeaway: know exactly which tool you are using, know why, and know the precise conditions under which it breaks. Heading into next week, 3 things are on the radar. First, the March CPI data releases on Friday, April 10th. This is a potential market-moving event that could affect SPY short call positioning and require rapid adjustments. Second, MARA options expiring April 10th will roll off, requiring the covered call legs to be renewed at updated strikes. Third, the short call legs of the new SPY PMCC positions still need to be sold against the December 2026 long calls to start generating weekly income. The VIX remains elevated, which means the premium selling environment continues to be favorable. Elevated volatility benefits the wheel directly. MARA moved from $8.04 to $9.67 this week, a gain of roughly 20%. On 46,546 shares, that single week move added approximately $75,870 in unrealized stock value to the account. For context, The $9,706 in net premium collected is meaningful, but is clearly secondary to the magnitude of the stock position. In a down week, this dynamic fully reverses. The stock P&L will drag the account lower, while premium income will still come in positive. The wheel does not reverse a falling stock. It cushions the fall and systematically reduces the average cost basis over time. That is the honest and complete framing of this strategy. This is Trade of the Week, number 1. Every week, this series will break down exactly what was traded, what it cost, what the outcome was, and what the data says about the decision. Real portfolio, real numbers, no hypotheticals. If you want to follow the rebuild in real time, subscribe to Mathematical Money. The next episode will cover the following week's trades with the same level of detail. Stop guessing at option strategies. Start calculating them. Disclaimer: trades shared here are from a personal account and are for educational purposes only. Nothing in this video is financial advice. Options trading carries significant risk of loss.